Welcome to Insurance World TV, your trusted channel for clear, practical insights into insurance and risk. If you're just joining us, welcome, and if you've been following the series, thank you for staying with us. This is the second video in our continuing series on financial ratios used to assess the strength and stability of insurance companies. In today's episode, we focus on one of the most important ratios in insurance, the claims ratio, also known as the loss ratio. We'll break it down in simple terms, explain why it matters, and show you how it's used by clients, regulators, and insurers to understand whether an insurance company can truly deliver on its promises. Let's get started. Introduction. Claims ratio, also known as loss ratio, is one of the most important financial ratios in insurance. It is highly depended upon by corporate clients, procurement entities, the regulator, insurance brokers, and individual policyholders who wants to understand the financial strength of an insurance company. Claims ratio tells you one critical thing: how much of the premium collected is actually going back to pay claims. To better understand this ratio, we'll break it down by answering a few critical questions that will help you see how it works in practice, why it matters, and how it can be used to make informed decisions. Question 1. What is claims ratio? The claims ratio, also known as the loss ratio, is a financial measure used in insurance to show how much of the premium collected by an insurer is used to pay claims. In simple terms, it answers one key question: for every 100 shillings an insurance company earns in premium, how many shillings go to claims? The formula used in calculating claims ratio is straightforward. Claims ratio equals incurred claims divided by earned premium times 100. For example, if an insurer earns 1 million Kenya shillings in premium and pays 650,000 Kenya shillings in claims, the claims ratio is 65%. This means for every 100 Kenya shillings collected by an insurance company as premiums, 65 shillings is paid to policyholders as claims. The remaining 35 shillings are used to cover operating costs, reinsurance, and profit. The claims ratio is one of the most important indicators of an insurer's underwriting performance, claims paying behavior, and financial sustainability. Question 2. Why does claims ratio matter? Claims ratio matters because insurance is, at its core, a promise to pay claims. When a policyholder pays premiums, they are buying peace of mind, the confidence that when a loss occurs, the insurer will step in and pay. Claims ratio helps us answer a very important question: is the insurance company actually delivering on that promise in a sustainable way? If an insurer consistently pays claims fairly and on time, its claims ratio will reflect that. If an insurer struggles to pay claims, delays settlements, or rejects valid claims, that will also show up in its claims ratio. From a financial stability perspective, a very high claims ratio may indicate that the insurer is paying more in claims than it earns in premiums, which can weaken its capital over time. A very low claims ratio may suggest that claims are being underpaid, disputed, or that premiums are unrealistically high. A balanced claims ratio shows that the insurer is pricing risks properly, paying claims, and remaining financially stable. In short, the claims ratio sits at the intersection of policyholder protection, underwriting discipline, and long-term insurer sustainability. That is why regulators monitor it closely, why corporate clients analyze it before placing large risks, and why it should matter to anyone choosing an insurance company. Question 3. Where can one get the data to calculate claims ratio? So, where can you actually find claims ratio data? The good news is, you don't need insider access or confidential information. The data is publicly available if you know where to look. Here are the most reliable sources in the Kenyan market. Number 1. Insurance company financial statements are the primary source of this information. These statements are published annually by insurance companies and are usually available on their websites or through regulatory filings. Number 2. The second source of these data are the Insurance Regulatory Authority reports. The Insurance Regulatory Authority regularly publishes annual insurance industry reports, market performance statistics, and summaries by class of business such as motor, medical, and property. These reports are especially useful for comparing industry averages and understanding broader market trends. You will get the data for calculating the ratios in these reports. Number 3. The third source is Association of Kenya Insurers publications, which consists of market research, industry briefs, and performance reviews. These publications help you understand sector-wide claims trends and how different classes of insurance are performing. Number 4. The final source we will mention here are the audited annual reports of listed insurers. For insurance companies listed on the Nairobi Securities Exchange, audited annual reports are available on company websites and through NSE disclosures. These reports are independently audited, making them a strong and reliable data source. From these reports, you can obtain net earned premiums and net incurred claims, which are the key figures used to calculate the claims ratio. A critical tip: always ensure you are using net figures. That is, amounts after reinsurance. Using net earned premiums and net incurred claims ensures fair comparison between insurers and a more accurate picture of true risk exposure and financial strength. This approach allows clients, regulators, and analysts to make informed and objective assessments of insurance companies in Kenya. Question 4. How is claims ratio calculated? Now, let's make this very practical and very simple. Calculating the claims ratio does not require complex accounting skills. Once you have the right figures, the math is straightforward. Here are the 3 easy steps applying the formula. Claims ratio equals incurred claims divided by earned premium times 100%. Step 1. Take the net incurred claims figure. This represents the total value of claims the insurer has paid or expects to pay after reinsurance. Step 2. Divide that number by the net earned premium. This is the portion of premium that actually relates to the period being analyzed. Step 3. Multiply the result by 100% to convert it into a percentage. That's your claims ratio. Let's walk through a simple example. Assumed an insurance company reports net earned premium of 2 billion Kenya shillings and net incurred claims of 1.4 billion Kenya shillings. The calculation would be claims ratio equals 1.4 divided by 2.0 by 100%. This gives us a claims ratio of 70%. What does that mean in practical terms? It means that for every 100 shillings collected in premium, 70 shillings were paid out to policyholders as claims. And that's it. No complicated formulas. No technical jargon. Just a clear, powerful number that tells you a lot about how an insurance company operates and manages risk. Question 5. How is claims ratio interpreted? Now, this is where the real insight comes in. A claims ratio on its own is just a number. What matters is what that number tells you about the insurer's behavior, discipline, and financial strength. Let's break it down using a simple and practical guide. If the claims ratio is below 50%, at this level, the insurer is highly profitable from an underwriting perspective. On the surface, this may look very attractive. However, it can also raise important questions. Number 1. Are claims being underpaid or delayed? Number 2. Are valid claims being rejected too often? Number 3. Are premiums priced significantly higher than the risk requires? For regulators and corporate clients, an unusually low claims ratio may attract scrutiny, especially if customer complaints are rising. If the claims ratio is between 60% and 80%, this is generally considered a healthy and balanced range. At this level, claims are being paid, pricing reflects actual risk, and the insurer retains enough margin to cover expenses and remain profitable. Many well-managed insurers aim to operate within this range because it supports long-term sustainability and policyholder confidence. If the claims ratio is between 80% and 100%, here, the insurer is operating in a claims-heavy environment. Claims are consuming most of the premium income, which means profitability is thin. Expenses must be tightly controlled, and reinsurance becomes critically important. While this range is not automatically dangerous, it leaves very little room for error, especially during years with large or unexpected losses. If the claims ratio is above 100%, this is a red flag. A claims ratio above 100% means the insurer is paying more in claims than it earns in premiums. This results in underwriting losses, pressure on capital, and reliance on investment income or shareholder support to survive. If this situation persists, it threatens the insurer's long-term financial stability. Why this interpretation matters. For corporate clients and procuring entities, understanding the claims ratio helps you avoid insurers that may struggle to settle large or complex claims and select insurers with a proven track record of claims-paying ability. For regulators, the claims ratio highlights insurers that may require closer supervision, corrective action, or capital strengthening. For insurance companies, the claims ratio drives pricing decisions, underwriting discipline, portfolio selection, and reinsurance strategy. In short, the claims ratio is not just a performance metric, It is a decision-making tool that affects every stakeholder in the insurance ecosystem. Question 6. How do you contextualize the claims ratio? The claims ratio should never be looked at in isolation. To truly understand what it is telling you, you must place it in the right context. Here's how to do that. Number 1. Compare it to the industry average. The first question to ask is, how does this insurer compare to the rest of the market? A 75% claims ratio may be healthy in one market, but concerning in another. In Kenya, regulators and analysts often look at industry-wide averages by class of business, for example, motor, medical, property. If an insurer's claims ratio is significantly higher or lower than peers, that difference deserves closer examination. Number 2. Consider the class of insurance. Not all insurance products behave the same. For example, medical insurance naturally has higher claims ratios than property insurance. Motor insurance may fluctuate due to fraud, court awards, or repair costs. Long-term insurance behaves very differently from general insurance. So always ask, is this claims ratio reasonable for this specific line of business? Number 3. Look at trends over time. 1 year's number is not enough. You should examine the claims ratio over 3 to 5 years. A steadily rising claims ratio may signal worsening risk selection, pricing problems, or weak claims control. A stable ratio over time suggests disciplined underwriting, predictable risk management, and financial resilience. Number 4. Analyze it together with other ratios. The claims ratio becomes far more powerful when combined with expense ratio, combined ratio, capital adequacy or risk-based capital, and liquidity ratios, such as the current ratio. An insurer may have a high claims ratio but still be strong if expenses are well controlled, capital is adequate, and reinsurance is effective. Number 5. Factor in reinsurance and risk strategy. An insurer with strong reinsurance support may safely operate at a higher claims ratio without threatening solvency. Without adequate reinsurance, the same ratio could be dangerous. Always ask, how much risk is the insurer retaining on its own balance sheet? Contextualizing the claims ratio means asking better questions, not just reading numbers. It helps you understand whether claims are being paid fairly, whether pricing is sustainable, and whether the insurer can withstand shocks. In short, the claims ratio tells a story. Context tells you whether it's a success story or a warning sign. The claims ratio tells us how well an insurer balances promises made with promises kept. It also shows whether claims are being paid, whether pricing is sustainable, and whether the insurer can remain stable in the long term. For anyone assessing insurance companies in Kenya, this is not an optional metric. It is a must-understand ratio. That marks the end of this episode in our Financial Ratios for Insurance Companies series. In our next video, we will break down the claims coverage ratio and show how it differs from the claims ratio. If you found this video helpful, like and share it, leave us a comment, and subscribe to Insurance World TV so you don't miss the next lesson. Until next time, stay informed and stay insured.